water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Mark comes from a proud military family, including his father Victor and his brother Timmy. Mark talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Mark is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Mark, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Mark Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we've got a guide available this month titled Understanding Required Minimum Distributions. Mike, a lot of changes in the RMD landscape. When do people have to take RMDs from either IRAs or Roths?
How old are you?
Me personally?
So this does start changing now. It is currently 73 for a lot of folks. For some younger folks, it's actually now going to be 75 years old for your traditional IRAs and 401ks. And so that started at 70 and a half just a few years ago. And so this is a new set of rules for a lot of people.
When you look at how the penalty situation has evolved, this is one area that's actually gotten a little bit more lenient in recent years. And so that's something where if you are new to RMDs, there are some incentives if you've missed one to get that squared away as soon as possible.
There are, but, key takeaway. Understand these rules and don't miss your required minimum distribution, because there are still penalties for something that, again, is completely avoidable. Yes, the penalties used to be bigger. They are less stringent now and a bit smaller, but it is still unnecessary extra taxes and fees that you will end up paying if you do miss your required minimum distribution. So get our guide and learn a little bit more about how all of this works.
Folks, the guide is titled Understanding Required Minimum Distributions, and there are two ways that you can request it. The first is by calling 800-393-4001. The second is by visiting armstrongadvisory.com. Again, that number is 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We pride ourselves on being able to support veterans in their time of greatest need, ensuring they receive the protections they deserve. For over 100 years, the DAV of Massachusetts has helped thousands of veterans with housing, transportation, and medical assistance, and you can help too. Please visit dav5k.boston and make a donation today. That's dav5k.boston.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Monday here on the Financial Exchange. Normally, this would be a pretty busy week ahead for economic data and earnings. This week, still busy week for earnings, but here's the economic data that we are not going to be getting because of the government shutdown. We're not going to be getting retail sales. We're not going to be getting producer price index. We're not going to be getting weekly jobless claims. We're not going to be getting building permits and housing starts, and we're not going to be getting consumer price index. So,
Building permits are federal data?
yes, they are. Census Bureau. So overall, we've got a bunch of stuff that we're not getting. So instead, we have to excite ourselves over, Jay Powell's going to give a speech at 12:20 p.m. tomorrow.
And Jamie Dimon's going to tell us how his company performed in the most recent quarter.
There, I think at least you can get some interesting signals about what's going on in the economy. So I do think that the banks can tell us something kind of interesting. But am I going to get all geared up for Neil Kashkari to give a speech at 6 p.m. on Thursday rather? No, I'm not. I'm over it. I don't need more Fed speakers. I was trying to think of a witty rhyme on the spot, but I couldn't get anywhere past.
I would guess that it's going to generate the same level of enthusiasm that my daughter's hockey games will. Immediate family only.
if
Neil's parents in the crowd.
If Neil's your son, do you show up to all of his speeches at this point?
Neil. I most certainly would. Right? Like accomplished in his field. Yeah, I would be at every one. Traveling on the road show.
If you're the Fed chair, do you get to show up to Jay Powell? Like, if you're the Fed chair's family, do you get comp tickets to his press conference?
Ooh, probably not.
It's my son up there. Put my son in the game. Let the boys play. Come on.
Markets, in the meantime, making up about half the ground that they lost on Friday. We'll be covering the U.S.-China tension news today, but markets were down. S&P was off nearly 1.9% on...
No, 2.7.
Sorry, 2.7%. 182
points,
I think. So, yeah, we're making up about half of that this morning in early trading as some announcements there. But those are the big pieces for this week as we look forward. And what day are we into the government shutdown here, Tucker? What number?
Is this 11?
13.
Oh, good.
He knew it was an odd number.
If it started on the 1st and today's the 13th, it
Makes
has
it
to be
pretty
the 13th
easy, huh?
day. The math is not particularly complicated.
I didn't recall when it started.
So, in any case, Friday, obviously the big move was after the Trump post about the potential increase in tariffs and increased tensions between the U.S. and China.
About 11 a.m. on Friday
Yeah,
morning.
just before 11 a.m. And so, you saw stocks basically fall continuously throughout the day. The real damage, quite honestly, was not in equity markets. Do either of you know anyone who is big into crypto?
No. Yes, but
No.
Didn't talk to them on Friday.
Probably a good thing. The folks that I've talked to in the crypto world have said that Friday was basically the biggest liquidation event that they have ever seen. I don't know exactly, what precipitated it in this and that, but in particular, when you get past some of the more well-known cryptocurrencies and towards some of the, off-brand, the so-called altcoins and stuff like that, there was some real damage with like some intraday moves being 90% plus down. And the stories that you've heard and seen are, people losing millions of dollars in a single day and people just being entirely wiped out in a number of cases. So I think the interesting thing to me when we look at markets and this China situation, markets have not cared about this in any real way since May. I know that the market bottomed in April, but it's really been since May and that first round of negotiations in, I think it was Geneva at the time where those take place. We've had subsequent rounds. I think maybe another one in Geneva, and then one in Madrid, I think it was. I'm just trying to keep track of all this. But ultimately, it's been still about 5 months since markets cared about this. And I think the biggest reason is there hasn't really been much of a threat out there from either China to the U.S. in direct fashion since then, or any response from the U.S. either.
Right. I mean, it's not to say that there haven't been real impacts on the ground. Go talk to anyone in the farming community, and you're not having basically any Chinese purchases of American agricultural goods. There are other effects and impacts throughout the economy, but in terms of the stuff that's driven markets, it's been pretty quiet between the U.S. and China. So why did markets suddenly pick up on this on Friday? And I have a couple theories as to why. The first is, look, this is the first, kind of re-escalation that we've seen in a public-facing manner in a few months. So I think that, maybe that's meaningful in some way, shape, or form. But it's not like markets have really cared about tariffs a whole lot over the last, few months, even where there have been other sporadic, changes and things like that. We had, higher tariff rates that went into effect in August. The market didn't really care about those. They weren't directed at China, which is obviously a major U.S. trading partner, but the market didn't really care about the August ones. Some of the sector-specific ones, market hasn't really cared about the last month or two. So I think some of this obviously is just, overall, when you talk about the two biggest economies in the world, if they start to be more on, a collision course, yeah, markets take notice a little bit. The other thing, quite honestly, is, and this is going to sound weird to begin with, but what if this wasn't actually about China, but just where the market was at this particular point in time? And just kind of any catalyst could have caused this. And what I mean by this is this has been a very, very calm market over the last 5 or 6 months, almost historically calm in terms of actual realized volatility in markets. And the big reason why this has been the case has been what we can call dispersion, which is a fancy way of saying not everything in the index has been moving in the same direction. In fact, it's been moving in really different directions. If you've watched this market for the last 6 months or so, it's been something where you say, hey, tech stocks are up and bank stocks are lagging today, but still we're moving up. And then the next day, hey, industrials are up and we've got utilities lagging, but industrials are dragging the index up. So ultimately, this dispersion has resulted in a really calm market, even though under the surface, individual stocks have been moving a decent amount. And one of the things that we then saw in the last week and a half or so is, as you started to see the last 2 weeks progressing for markets, the way that markets typically progress is by climbing a wall of worry, and the way that you can measure that wall of worry is through something called the VIX. VIX is often called the fear index, but it basically measures, hey, what is the implied volatility of the S&P 500 over the next month based on options that are out there? How much do market participants think the market's going to move on any particular day or over any particular month? And generally what you see is when stocks climb the wall of worry, it's stocks up, VIX down. That's what you generally see, because as stocks do better, people think, okay, stocks are going to continue to do better. Sure. Which is generally how they perform. All-time highs beget more all-time highs. That's the general trend. For the last couple weeks, we saw this kind of weird thing in markets where it was stocks moving up, but the VIX moving up as well. And where this starts to cause problems is there's an awful lot of money that is traded in what we call systematic fashion. And this is a fancy way of saying it's rules-based trading. I'm not talking about high-frequency trading, but rules-based trading, where
there are these funds that are out there called volatility control funds, or you also have trend following strategies and things like that. But a lot of it is based off of, hey, how much volatility is in markets, and when volatility goes up, we pull back in order to protect our investors from moves in markets. That's how volatility control funds typically work. And eventually you get to a breaking point where if the VIX goes up enough, they start selling and things start moving. And so I guess my question on this is yes, like the China thing could have been the initial catalyst, but the rest of the move isn't necessarily related to investors being like, oh no, this is, this huge, China thing. But maybe the market was just primed for this because of how the underlying market structure was set up. And
I suppose, but you still needed the news for it to be sparked.
You needed some kind of catalyst. I guess my point is, if it wasn't this,
might have been something
it
else. It
could have been something else. Something else comes out on First Brands today, or something comes out, on a financial earnings report this week, and that's the impetus for this move anyway.
I guess I just find it intriguing that, look, when it comes to tensions between the U.S. and China, it takes two to tango.
You would think that, but occasionally you can tango by yourself.
You kick this off on, what was it, Wednesday night when the Chinese announced these new restrictions?
Yeah, and
markets didn't react at all.
No, and Thursday was pretty calm.
It took the post from the president at 11 a.m. to spark this sell-off in markets. And so, again, this is kind of why I don't take it all that fundamentally seriously at the end of the day, and why I hope and think that it ends up being more posturing than much else, because...
Which is what we speculated at the time.
Yeah, we speculated that on Thursday, that, you're posturing ahead of a negotiation, and frankly, the commentary from the President of the United States over the weekend seemed to insinuate the same.
Let's take a quick break. When we return, let's see, should we talk rare earths after this? Ooh, I think we should.
Yeah.
The Financial Exchange streams live on YouTube. Subscribe to our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
Mark Vonner is the CEO of Veterans Development Corporation. His dedication to serving our veterans has made an incredible impact on his family and employees. And he is so proud to be the presenting sponsor of the DAV 5K Boston.
My name is Ashley Vonner, Director of Operations at Veterans Development Corporation. I wanted to learn the family business under the guidance of my father, Mark Vonner. VDC is more than a general contractor. It's a service-disabled, veteran-owned small business that goes above and beyond for the veteran community. With Mark's military background, serving in the Marine Corps, our company is committed to supporting the Disabled American Veterans Department of Massachusetts. VDC has been the presenting sponsor for the DAV 5K for many years, striving to spread awareness of this great organization. Working for Veterans Development Corporation has shaped me into the person I am today, and I am proud to be a part of this organization.
Please visit dav5k.boston to show your support today.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Turning 70 isn't just another birthday. It's when the clock starts ticking on your retirement withdrawals. At age 73, or at age 75 if you were born in 1960 or later, you need to start withdrawing money from your IRA. They're called required minimum distributions, and missing one can mean big penalties. Taking the RMDs at the wrong time can also spike your tax bill. Even the type of account matters, since your IRA and 401k follow different rules, which could get confusing fast. Our new guide is called Understanding Required Minimum Distributions. It breaks the process down in simple terms so you know when to start, how much to take, and ways to manage the tax impact. Request your copy today by calling 800-393-4001. That's 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Cushing & Dolan want to help you make the most of your estate plan, starting with how you gift your assets. Their brand new guide, Making the Most of Gifting Assets, breaks down the pros and cons so you can avoid costly mistakes. Gifting may sound simple, but it can create complications you may not see coming. For example, if you gift your primary home to your kids and they sell it, they could face huge capital gains taxes, and that surprise bill could derail your plan. It's the kind of insight that can help you protect what you've built and keep your family's future on track. Whether you're just getting started or you're deep into your estate plan, this guide from Cushing & Dolan is a must-have to make smart, informed decisions. Call 866-848-5699 right now to get your copy. That's 866-848-5699. Or request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you by the U.S. Virgin Islands Department of Tourism. Looking for a getaway that's easy, warm, and unforgettable? Discover the magic of the U.S. Virgin Islands, St. Croix, St. Thomas, and St. John. Just a short flight from New England with no passport needed and no money to exchange. Soak up the sun, stroll along white sand beaches, and feel the rhythm of the heartbeat of the islands. The USVI is America's Caribbean paradise. Plan your fall escape now at visitusvi.com. That's visitusvi.com.
So the center of all the hubbub last week between the U.S. and China is China's new export restrictions on rare earth materials. And specifically, basically what China is putting in place here is it says, look, if you have any product that uses more than 0.1% of rare earths in its construction.
I think it was more if the value of the product is more than 0.1% derived from those rare earths. But
then we have the ability to restrict your sales of that product worldwide.
Is it the sales of the product or your ability
Yes.
to get the...
No, we will not necessarily license you to be able to sell your product worldwide.
Meaning you can sell whatever you want, but we won't give you any new rare earths.
That's a nice business you've got there. Would be
Yeah.
a shame if anything happened to your rare earth supply.
Right.
Is basically the sign
Correct.
here. Now, over the weekend, they've tried to, soften that stance to, well, we're likely going to approve most of these. It's really just for military applications and this and that. To which then you get into, okay, like some of this stuff you see and you say, okay, here's a clear military application, but there's a very easy way that you could say that semiconductors are being used for
Sure.
military applications because they are,
Yeah.
and it's impossible to prove exactly where they go. This is also now a critical problem for the United States because one would imagine, hey, even if China is approving rare earth exports for GM or Ford or whoever is building cars and whatever, they're probably going to be a little bit stringent about it when it comes to, Raytheon, and you do need this stuff when you're building Patriot missiles, because in order to build a motor that doesn't melt when you need to turn the missile very quickly in a short period of time, you need these rare earths.
Yes.
So, what does this actually mean? We're going to have to see what the implementation is, but this is why it's potentially a devastating blow to, the ability for companies across a wide range of industries to operate if they can't get the rare earths that they want.
And
now,
all the posturing back and forth, you've had many U.S. lawmakers coming out and saying that the United States is far more leverage on China than they do on us. I really would encourage everybody to just turn that stuff off because it's a game of chicken.
doesn't matter who has more leverage.
It does
matters
not matter
who blinks first.
It's about who is more who blinks first, who is more willing to accept more pain.
It's the whole game.
And I would argue, by the way, that we won't get there because all of this looks to me like a bunch of posturing ahead of a scheduled meeting between the two presidents so that each of them is able to soften their position during that negotiation.
And come away saying, yep, we got concessions on this and everything's great. Like that's, if we're being honest, that's probably the most likely outcome, but
yeah,
you don't know because there is no stable equilibrium
Sure.
in a game of chicken. Now, we also then get this piece this morning, JP Morgan to invest $10 billion in U.S. companies critical to national security. The subheader, bank pledges to take stakes in companies such as mineral producers, artificial intelligence firms, and others. Let me say something. When it comes to like rare earths and anything related to them, even tangentially, or even just like general mining related, while I do think that over the next couple of years, like pricing on this stuff could get nuts as everyone competes for it, doesn't it feel like we're ultimately heading for a massive oversupply on this stuff like 5 to 7
100%.
years from now? Like,
100%.
Now that everyone's talking about it, there's all this money that's going to seek it out and say, yes, like let's do this. Let's figure out how to do this. We're going to chase this.
There is a real path for the U.S. government basically saying that there is now a price floor for certain rare earths coming out of the United States.
Totally.
Right? Like that is very likely where this could all go.
And I'm not saying this is a bad thing.
Sure.
What I am saying is
terrible business.
It's not necessarily good for the overall business of rare earths because eventually, if you overproduce this stuff, then the U.S. government's going to say, okay, let's pump the brakes. And if your business is dependent on the U.S. government to be the buyer of last resort, once you reach that oversupply and you have, a national neobidium supply, that's, stuck aside. I think that's one of the rare earths. I might have just made that name up, but it sounded
good.
Yeah. You're going to reach a point where you overproduce this stuff.
Even if the U.S.
Which is fine, I'll add. It's because the risk of underproducing,
pretty bad.
We're seeing right now.
Even if the U.S. doesn't overproduce it for our own domestic consumption needs, you can be sure that the Chinese have the ability to. And so, again, if this reaches a point where for-profit companies are trying to compete with Chinese ones on rare earth materials, which I don't think is what we're going towards, but in a free capital market, at least on the U.S. side, they'll be put out of business by Chinese counterparts because they will flood the market like they have done with many other items, which is how we ended up here in the first place.
Right. If you look at the defining characteristics of the U.S. and Chinese economies, the U.S., we've never met a debt we didn't like. China, we can always sell more of it cheaper than you.
Yeah.
Like those are like the defining characteristics in terms of where the excess comes from. The U.S., well, we can buy more than you can. China, but we can produce more than you can.
Yeah,
like that's kind of the tension that you have between the two systems and the way that they are set up,
which is great for TVs and bad for rare earth materials.
What about rare earth TVs? A TV that spins because of a magnet in it.
Sounds like it would cause cancer.
or just dizziness. Let's take a quick break. When one returns, one will do Wall Street Watch after this.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Vance Health Foundation.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
Bye, guys.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com. Cushing & Dolan know that gifting assets can be one of the most emotional and challenging parts of estate planning. Their new guide, Making the Most of Gifting Assets, can help you learn what to consider before making a major gift, like your primary home or a vacation property, and avoid unintended tax problems. Call 866-848-5699 to get your copy, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. If you're approaching your 70s, you might be thinking about slowing it down, but the IRS is just getting started. Required minimum distributions, or RMDs, kick in starting at age 73. And if you were born in 1960 or later, that number jumps to 75. RMDs are more than just a box to check. They can impact your taxes, your income plan, and even what you leave to your heirs. If not done properly, it could mean big penalties, but getting them right might help keep your money working for you. Our latest guide, Understanding RMDs, breaks down how they work, when to take them, and strategies that may make them less of a tax headache and more of a financial opportunity. Request your copy today by calling 800-393-4001 or by visiting armstrongadvisory.com. That number again is 800-393-4001 or armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan, with their master's in taxation. And today we're talking about the implications of gifting assets away. Todd, if you're trying to protect your assets from the cost of long-term care expenses, what are the risks in giving your assets to a child rather than transferring them to an irrevocable trust?
Yeah, it's a very big difference, right? These irrevocable trusts that we do for Medicaid purposes, first and foremost, are incomplete gifts. So you're not actually making a gift at all when you put it into these trusts. But if you give it to a child, now you've made a completed gift. So, for example, if I gave away my house, and people do it, right? You are giving away the built-in gain in that house. You now don't have any control over the house. You can't sell it and buy another one if you want to move. You need the kids' permission for all of that. Plus, if you never sell it and you die, you've trapped the built-in gain for the kids. When they go to sell it, they're going to have to pay capital gains tax. Whereas if you keep it, you can control it, get a step-up in basis for the kids when they die, and still protect it from the nursing home through the trust. Either way, it's going to take 5 years. But gifting isn't always the answer.
Educate yourself about the implications of gifting your assets away. Request your free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699. That's 866-848-5699. Or you can request a copy on their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Markets are rebounding to begin the week after Friday's sell-off, after President Trump followed up his social media post yesterday saying, "Don't worry about China, it will all be fine." Trump's initial post on Friday was critical of China threatening massive tariffs. Right now, the Dow is up nearly 1% or 420 points higher. S&P 500 up 1.2% or 83 points higher. NASDAQ up 1.8% or 408 points higher. Russell 2000 is up over 2%. Bond market closed today in observance of the holiday, and crude oil up 1.5% today, trading at $59.77 a barrel. MP material stocks surging 20% after the Pentagon recently took a stake in the rare earths producer, adding to its recent rally. Last week, China tightened rare earth export controls. Other miners, including USA Rare Earth, critical metals, and energy fuels, are also seeing strong gains on the day. Meanwhile, shares in Broadcom rallying nearly 9% following news that OpenAI signed a multi-year pact with Broadcom to collaborate on custom chips and networking equipment, where the two companies will jointly build and deploy 10 gigawatts of custom AI accelerators. Elsewhere, shares in Warner Brothers Discovery rising over 4%, following reports that the company had rejected Paramount Skydance's proposed buyout of roughly $20 a share. Furthermore, reports also say that Paramount CEO David Ellison is making a play to buy all of Warner before it splits and may take his offer directly to shareholders. JP Morgan Chase up over 2% after the bank said it would directly invest $10 billion in companies it deems critical to national security. Speaking of which, JP Morgan Chase and other major banks, including Wells Fargo, Goldman Sachs, BlackRock, and Citigroup, will post their third quarter earnings ahead of tomorrow's open. Outside of banks, Johnson & Johnson, Ericsson, Domino's, and Albertsons will also report their third quarter results ahead of the opening bell. I'm Tucker Silva, and that is Wall Street Watch.
Piece here from, this is Bloomberg, from Tricolor to Saks, bonds are now crashing at breakneck speed. Well, I mean, I think that's kind of broad. I mean, bonds as a whole are generally fine. In fact, the 10-year Treasury had a nice little bid to it on Friday in all of the commotion and hubbub. But, yes, I think that the general stance of, hey, if your company has way more debt than investors thought and you declare bankruptcy, your bonds are going to crash is a pretty, respectable place to land.
By the way, I mean, yeah, crashing to me implies something different than what we've seen. I'm taking a look at data from St. Louis Fed. It's the B of A U.S. High Yield Index option-adjusted spread. So they're looking at junk versus risk-free asset. And we were sitting at a spread of 2 3/4 last Monday. We're up to 2.95. It doesn't seem like spreads have blown out on the riskier bucket. Now, I will acknowledge for a minute here that many are arguing that the junk market, which is what we're actually measuring here, has been partly de-risked by this exact factor of private credit, and so maybe that's not where the risk lives, and we should be more focused on this private credit industry that you can't meaningfully measure. But yeah, it does not. At the very least, it is not a risk-off-everything type of trade right now in bonds.
No. Now, that also doesn't mean that you're going to be fine. As an example, if you look at the historical spreads on CCC debt, just as an example, which is basically like the lowest quality of junk debt before you get to defaulting, in May of 2005, the spreads on CCC debt were 9.5%. So you got paid a hefty, nice little margin to do that.
Yep.
To lend to those companies.
Again, that's the spread between treasuries of a similar maturity?
Yes.
Got it.
By June of 2007, that spread was down to 4.1%. Well, we all know what happened afterwards.
Yeah.
Those spreads blew out during the financial crisis, and in November of 2008, that spread was north of 44%.
Yeah.
So I do think that credit spreads are not usually they're not usually a great leading indicator. They're often a coincident indicator. Now, they did start to show problems. So from June of 2007 through March of 2008, that CCC spread went from 4 up to 12.
Yeah.
So you started to see it building towards the financial crisis there. And then obviously when everything happened in the fall of 2008, they went, just nutty. But
so what if that signal's gone now?
And this is the problem, is the private credit industry has taken a lot of below investment grade debt and taken it out of public markets where you get accurate price discovery on a daily basis, and instead It might be just one company that's holding all of that debt, and so it doesn't reprice. It might be a few, but it still doesn't reprice because there's no secondary market for it and it doesn't trade. And so the two questions that are out there, number one is, hey, have we lost, an aspect of price discovery in the junk bond market because so much of it is held privately as opposed to in publicly traded bonds now? And the second piece there, and this is the part to me that is reminiscent of '07, is it's in a different area. In '07, it was, hey, we're holding all of these mortgage-backed securities. Are these worth anything? Was the question then. Now the question is realistically, hey, we're holding all of these, privately made loans. What if there's more first brands? And if there are, is what we're holding worth anything?
Right. And who is left holding?
And so these are the questions that every private credit lender is asking right now, and they don't have answers.
I'll be the first to say that S&P as a rating agency frequently gets some things wrong here and there, but Financial Times is reporting that the rating agency S&P has warned U.S. insurers of the risks of the complexity and lack of disclosure in the private credit market. So if you're wondering, again, what is one holder of all of this debt that you interact with very frequently, it might be your insurance company.
Not just one, Michael, a massive one. Insurers over the last 3 to 5 years have been some of the biggest buyers of collateralized loan obligations from private credit. And the reason why is simple. If you are in a competition to, keep the lowest rates possible and not raise your rates because of, all of the things going on in the world over the last 5-6 years.
And also look attractive to your investors from a growing profitability standpoint.
Correct. One of the best ways that you can do that is say, yeah, if I can go out and buy a pool of private credit that's yielding 12% instead of holding treasuries yielding 5%.
With your premiums, by the way.
Sure, of course insurers are going to say, yeah, it's, highly rated. Why wouldn't I do that? And this is the part where there are some real echoes of the financial crisis.
Right.
And you just don't know what the scale is. You don't know what the scope of it is. It is.
Well, that would really suck if we took it out of the, too big to fail banks. We took all the risk out of there and we put it into a bunch of insurance companies who are also too big to fail.
Well, and it's
what if 3 insurers went down in the United States? And it would sink the entire market.
And it's all this whole mechanism is, hey, the banks aren't making these loans. It's all non-bank lending that's going on. It's all, these asset managers that said, yeah, we have these vehicles that we're setting up in order to lend money to companies, and you're going to get yields of, 8 to 12% on this, but don't worry, it's fine. It's safer than public markets because it doesn't trade. Well, no, that just means there's no mark-to-market efficiency that you get there, and so you don't know what the value is. And
it'd be one thing if the insurance companies' businesses were relatively stable in the first place, which they're not.
Look, I got to tell you, I hope I'm wrong about this, but I'm getting this not great feeling about this whole space now. And it's not that everything's going to be a mess. It's not that it's going to be, financial crisis 2.0, but it's rare that you just see 2 defaults in the auto sector and then everything else is fine.
Hunky-dory.
That doesn't really feel like what's happening here. And I'm just my spidey sense is just tingling a little bit in this whole space right now. And of course, then you also get the piece in the Wall Street Journal. Jefferies seeks to calm worries over First Brands because, hey, when First Brands has $10 billion in debt and Jefferies, one of their investment funds, Point Bonita Capital Investment, held 7% of that in one fund. You're do you guys understand the principles of diversification amongst poorly rated lending risks?
No, next question.
And this is where historically, you give banks a lot of credit because aside from 2008, the thing about banks is normally they're really conservative. The biggest problem that you get with banks, especially you could even make the case since then, banks don't really like making loans. They're scared to make loans for a number of different reasons. This here, when you look at what's going on in private credit, it's just the Wild West. It's, oh, sure, I can underwrite that for, this. Of course we can do that for you. And it just gives me the willies right now. I've got the willies. Let's take a quick break here, and when we come back, we'll talk about the September CPI report that we're actually going to get next Friday, right after this.
The latest news on inflation, the Fed, the economy, and how the markets are reacting every morning, right here on the Financial Exchange Radio Network. Cushing & Dolan know that gifting assets can be one of the most emotional and challenging parts of estate planning. Their new guide, Making the Most of Gifting Assets, can help you learn what to consider before making a major gift, like your primary home or a vacation property, and avoid unintended tax problems. Call 866-848-5699 to get your copy, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Turning 70 isn't just another birthday. It's when the clock starts ticking on your retirement withdrawals. At age 73 or at age 75 if you were born in 1960 or later, you need to start withdrawing money from your IRA. They're called required minimum distributions, and missing one can mean big penalties. Taking the RMDs at the wrong time can also spike your tax bill. Even the type of account matters, since your IRA and 401k follow different rules, which could get confusing fast. Our new guide is called Understanding Required Minimum Distributions. It breaks the process down in simple terms so you know when to start, how much to take, and ways to manage the tax impact. Request your copy today by calling 800-393-4001. That's 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping and the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network.
All right, so late last week, we did get word from the BLS that they were recalling their CPI staff. Imagine being like, if you're running that report, are you the director of inflation?
Ooh. Yeah, what does it say on your business card?
Director of inflation, I would hope.
Yeah.
But in any case, they're recalling the staff in order to make them essential from non-essential. The reason being, the September CPI report directly feeds into the cost of living adjustment for Social Security next year. And so this is obviously something that you need to get in a timely fashion, just because there's a lot that goes into then making that work. I don't think you just like go in and say inflate everything by X percent and it works immediately. I think there's probably a little bit of a process to it there. So we aren't going to be getting CPI this week as we were supposed to. It's going to be next Friday on the 24th instead.
Which will be ahead of the Fed meeting.
Yep, ahead of the Fed meeting. And so still, I think a valuable data point for us who are kind of starved for data points amongst the series that we're used to, but also means that we will know that Social Security cost of living adjustment in short order as well.
Yeah, you'll get all sorts of other adjustments that are used for tax filings. I think we already got the brackets, but things like 401k contribution limits and items like that would come in as part of this as well. But I think the important piece of all this, Chuck, is it does feel right now as though there are some increased concerns among investors, all while experiencing an absence of reliable data about this economy, which has not really led to anything terribly dramatic. And I don't really expect that it will during the government shutdown itself. But when you have this absence of information, investors are more and more reliant upon tweets and announcements, earnings reports that are going to be ongoing. And if you are finding yourself in a position where you're trying to sort these things through, we would love for you to join us. Obviously, you're listening to this program now, and we'd love to see you at our live event this Thursday in Chestnut Hill. We did one of these last week. It was well attended and a really fun time. Got to speak to people during the program, during the breaks during the program, but got to speak to people during the program and talk about these subjects on a real one-on-one basis. It led to a really great series of conversations, and we're doing another one of these this Thursday again in Chestnut Hill at the Showcase Superlux. It's free to attend. It's a live broadcast of this show followed by lunch and a chat with Chuck, myself, and the staff of Armstrong Advisory Group, really focused on our own outlook of what's going on in markets, what's going on in the economy, and what does it mean for average investors of all different types. So we would love for you to join us. You do have to register ahead of time. Obviously, we're closing in here on the date. It's this Thursday at the Showcase Superlux in Chestnut Hill. The number is 800-393-4001. If you're driving around right now, don't have time to call, check us out when you get home or when you get to work at armstrongadvisory.com. All the details right at the top of the page there. But this Thursday, Showcase Superlux, Chestnut Hill, 800-393-4001 to reserve your spot.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Piece in the Wall Street Journal, more working class Americans than ever are investing in the stock market.
Great news long-term, terrible news short-term.
Why is it terrible news short-term?
I guess it hasn't been for the last 4 years, but my guess would be that many of them jumped in over the course of the last few years during COVID and other events and invest on... There's probably a lot more investors as a percentage of the total that are not terribly experienced with market downturns, would be my guess.
That's fair. And look, every investor at some point goes through some kind of large drawdown, usually due to their own poor risk management and setup of their accounts. I know when I was starting out, I certainly had my days where I'm like, ooh, boy, that really sucks. Like, that's not great. You're not supposed to see, that kind of loss. But you hopefully, learn from your mistakes. Don't make the same one twice. And look, I'm a big believer in this because ultimately when we look at the playing field between labor and capital over the last 40 years, can we all agree that capital by and large has been winning?
Yes.
Doesn't it make sense then to play on the same side as capital?
100%.
And isn't investing in equity markets the way to do that?
Yes, so long as you can stick with it when times get rough.
Correct, because they will not just be linear. They're not always just going to go up. And especially, look, we have not had a prolonged bear market in 15 years or so.
Yeah.
You know, it's
had a few short ones, but, you know, the ones people need reminding of this. Like the 08 bear market took 4.5 years before it got back to its base level.
Forget that one, Mike. The tech bubble, the NASDAQ, took like 14 years to get back to its previous level. So,
and that might be more relevant to folks that are not in such a diversified portfolio.
Just understand these things have ups and downs. They are not linear, and volatility is the price of admission to equity markets.
Before we move on to the next story, Chuck, I've been thinking about them calling back the CPI staff, and all I've been going to is Keanu Reeves and the replacements. And I know it's not replacement staff, but I do like the idea of a ragtag group of statisticians being called in to put together the CPI report on next week. I don't think that's going to happen, though.
If you covered the CPI for the BLS, what would you like to cover? Like what section? If
food, because it'd be most relatable.
I would like to be the minister of eggs.
Although then I'd probably be 1,000 pounds. Just constantly looking.
You don't have to pay the prices in order to measure them, Michael.
I'd just be constantly talking about food.
This steak's so expensive and I'm already full.
No.
Lay off me, I'm starving. New Englanders are fed up with leaf-peeping tourists ruining their fall.
Get over yourselves.
You can't bite the hand that feeds you.
Yeah.
Like, I'm sorry. If tourism is what supplies, you know, the revenue for your town, that's kind of how it is.
Yeah.
Like, it's, I don't really know what else to say about that.
That said, tourists are terrible, and I get that they shouldn't be trespassing on your lawn, but yeah, that comes with the territory.
It's just what it is. Let's take a quick break. When we return, hour 2 coming up.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine, no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense. Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM, Concord, Boston. The Money Matters Radio Network.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping in the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all 3 and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Mark comes from a proud military family, including his father Victor and his brother Timmy. Mark talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Mark is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Mark, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Mark Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Understanding Required Minimum Distributions. Mike, one area with some big changes the last couple of years has been RMDs as it relates to inherited IRAs. What is the lay of the land today?
Yeah, so critical things that you need to know is that for most inheritors that are not spouses, so that's your starting point. If you are not married to the person who passed away, you are most likely subject to a out in 10 rule. What has also changed is that you're required to satisfy 2 different rules for most folks. Again, you are required to empty that inherited IRA within a decade. You also have annual required minimum distributions based on life expectancy. So it is really complicated now for inheritors.
How does that potentially influence how a parent may leave assets to surviving children in terms of taking their incomes into account?
Yeah, well, I mean, look, it is going to concentrate this additional income in a decade time period after you're gone. And so it adds a little bit bit of complexity in terms of that estate planning, right? Maybe I've got two kids. One's a very high income earner. One is a little bit lower. Do I potentially reshape my beneficiaries so that they both receive the same amount, maybe after taxes? A lot of complex planning you can do there.
The guide this month is titled Understanding Required Minimum Distributions. The two ways that you can request it are by calling 800-393-4001 or by visiting armstrongadvisory.com. Again, that number is 800-393-4001, or you can request it at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Chuck, Mike, and Tucker with you here, and as we kick things off today, we got stocks rebounding, making up about 40% of Friday's losses thus far. The Dow Jones Industrial Average up 400 points. The S&P 500 up 70. The NASDAQ Composite up 325. So broad-based rally taking place today. In general, you're seeing pretty good breadth across most of the indices. And again, making up about 40% or so of the losses that we saw on Friday when we had the first real single day volatility that we've seen in several months. As we take a look at markets to see what else is moving today, the 10-year Treasury not trading because the bond market is closed. You might ask yourself, hey, why is the bond market closed when equity markets are open? This is actually just a really
happens all the time.
Simple thing, but it's a good reason. The banks are closed in observance of Columbus Day, and banks cannot. If banks are closed and they don't have certain funding needs and pricing, then you don't have the bond market being open because you don't know how much money is being borrowed and lent and how much needs to change hands there, and so as such, the bond market is closed. Let's see, prices for commodities. We got gold continuing just to scream higher right now. It's up $120 an ounce to $41.20 and 40 cents, a 3% move up today for gold, breaking out to new all-time highs. You're seeing this across precious metals. Silver's up 6%, palladium's up 4%, so it's just happening across the board there. Crude oil, West Texas Intermediate, up $1.04 a barrel to $59.94 at the moment. When we take a look at the AAA national average for gas prices, breaking below $3.10 a gallon for the first time in quite a while. We're at $3.08 and 0.2 cents nationally. And if you happen to be listening to us throughout any of the Southeast or into Texas, you got gas prices down in the 260s, 270s throughout much of that region. So continuing to see those sliding toward the mid-2s if you're lucky enough to be driving through the southern middle part of the country right now.
It's the first real kickoff of earnings season this week. We'll have, in terms of the schedule here, J.P. Morgan, Wells Fargo, Goldman Sachs, BlackRock, Citigroup all reporting tomorrow before the bell, and in addition to Johnson & Johnson. Just wanted to get the big financials out of the way. Wednesday, we will be hearing from ASML, Bank of America, Morgan Stanley, Abbott Labs, and No, progressive as well on top of that. And then Thursday of this week, we'll have Taiwan Semiconductor reporting and Charles Schwab. So first real kickoff on the financial side.
Friday, we got a good one, too. American Express.
I didn't even look at Friday because they usually hold off.
I anticipate that Amex, again, good signals about kind of that higher-end consumer. I wouldn't expect to see many problems there, given what we've been hearing from retailers and, travel and hospitality. But interesting to see, what they say, and so I think they're one that I'm interested in as well.
Any unique insight you think any of these will share with us? I mean, I'm most interested to hear what, if anything, they have to say about that private credit space, but frankly, they don't have a lot of exposure to it, and so some of their customers do, I presume, but yeah, I guess we don't know.
You don't know if Goldman Sachs has a bunch of funds with private credit exposure, so it's we'll see what we hear. I also don't know that there's a great leading signal that you get from them. Remember, all the subprime stuff that blew up at the end of 2008, the first rumblings were coming second quarter 2007.
I wouldn't expect it, but if you had someone announce a bunch of loan losses that nobody was really anticipating, that would be a pretty good tell. But usually you don't get those until something really icky's happening.
Yeah, so we'll see what we get there. Piece in the Wall Street Journal. AI is juicing the economy. Sounds fun. Is it making American workers more productive? Ooh, that's an interesting question.
So, two-part question. Is it juicing the economy? Yeah, very clearly we are seeing building construction. We are seeing semiconductor investment and all sorts of things that are leading to increased employment, increased spending across this U.S. and global economy on the artificial intelligence infrastructure bets that are being made. And a few years ago, that was all just big dreams. Today, it's actual spending. You are actually seeing boots on the ground, constructing data centers. You are seeing maybe not, actual utility and power generation construction, but permitting and announcements on that front. And so I think you can easily say that AI is juicing the economy. And frankly, without the AI trade juicing the economy, I'd be quite concerned about economic growth given what's fallen off on the housing side of things. So yes to the first part.
So is it making employees more productive? Here's what I'll tell you. And again, I try to talk to a lot of people just so that I can get a sense of, kind of a broader swath of what's going on. I read this article and it confirms kind of what I've heard. All my friends who work in the tech space say that this is absolutely changing how they work on a daily basis. And I think there are two reasons for that. The first is it generally seems like large language models have some pretty useful things that they can do on the coding front to speed up a lot of those processes.
Yes.
And so if you're directly involved in, the production of tech products, yeah, there's definitely something there. The second piece is, hey, if you work for a tech company, you're typically exposed to a lot of these tools early and often relative to someone, who might work in a different industry. And so you're able to pick these up, kind of you're at the tip of the spear when it comes to adoption in a lot of these areas as well.
May I add a third piece?
Yeah.
If you work in the tech space and don't say that you are being made more productive by artificial intelligence, I'm unsure you have a job tomorrow.
Yeah, but they're telling me.
I get that.
I'm not their boss.
I get that. And that's where a difference between closed-door conversations versus reality sets in. But I think that third piece is playing a role across many other places where, I better say that I'm more productive because of artificial intelligence, because if I don't say it and if I don't prove it, then I might not have a job tomorrow, and as a company, I might not have an investor tomorrow.
And I think that other than what we're seeing in tech, I'm unclear if most other industries are seeing any major shift at this point in the aggregate. I know that JP Morgan came out last week and was like, "Yar, we're going to spend $2 billion on artificial intelligence and sound like a pirate." Like,
I'm just wondering if JP Morgan sounds like a pirate to you, the name of the company, or if something
I don't know.
they're doing.
They just wanted to make like a big hullabaloo of like, I can't stand when companies are like, well, we're spending this much on this new technology. Okay, is that like good? Like, I don't know if that's good or useful or anything.
Sure.
But they said they're going to be spending $2 billion a year on AI. That's fine. It's all well and good. You're hearing it anecdotally in other places, but I'm just not sure that across the board you're seeing a meaningful shift right now.
Sure.
You're also obviously seeing all of the concerning things regarding AI technology, such as, the fact that it's not necessarily right as often or more often than humans in a lot of instances. It's also obviously something that comes with a whole bunch of societal questions, whether you're talking about, hey, how do we deal with potential, large-scale job displacement, to why is AI allowed to talk to minors in sexually explicit terms, to, again, like you even get some of the like stuff that's, it's hard to find too much that's worse than that, but it's out there when you talk about, some of the things along the lines of, AI encouraging people towards self-harm and things like that. I mean, there's some pretty bad stuff out there. And quite honestly, this is like before you even get to the fact that, hey, I don't really think that, Mark Zuckerberg has proven himself to be, a great steward of ethical technological use historically.
Yeah. What I'm really interested to see, so coming from the perspective of, a company that is not JP Morgan and doesn't have $2 billion to spend on developing their own artificial intelligence tools, right? Like that's where I think most Americans land. Our company demoed a tool that I found compelling. It was a artificial intelligence tool designed to help you fill out paperwork faster, right? Like, because what's the crappiest part of almost any white collar job out there? It's probably and some blue collar jobs is filling out paperwork. And so we took a look at that, and interesting product, interesting company. The cost of said product was probably more expensive than just hiring a person to do it. And so we're very much still at this early stage too, where even if it does make someone more productive, I'm wondering how much money some of these companies are really spending to produce a product that, yes, makes somebody more productive at a not terribly affordable cost.
Let's take a quick break. When we come back, Ted Rossman from Bankrate is going to join us talking about their 2025 holiday spending survey.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Subscribe to our page and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping in the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com. Cushing & Dolan want to help you make the most of your estate plan, starting with how you gift your assets. Their brand new guide, Making the Most of Gifting Assets, breaks down the pros and cons so you can avoid costly mistakes. Gifting may sound simple, but it can create complications you may not see coming. For example, if you gift your primary home to your kids and they sell it, they could face huge capital gains taxes, and that surprise bill could derail your plan. It's the kind of insight that can help you protect what you've built and keep your family's future on track. Whether you're just getting started or you're deep into your estate plan, this guide from Cushing & Dolan is a must-have to make smart, informed decisions. Call 866-848-5699 right now to get your copy. That's 866-848-5699. Or request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Turning 70 isn't just another birthday. It's when the clock starts ticking on your retirement withdrawals. At age 73 or at age 75 if you were born in 1960 or later, you need to start withdrawing money from your IRA. They're called required minimum distributions, and missing one can mean big penalties. Taking the RMDs at the wrong time can also spike your tax bill. Even the type of account matters, since your IRA and 401k follow different rules, which could get confusing fast. Our new guide is called Understanding Required Minimum Distributions. It breaks the process down in simple terms so you know when to start, how much to take, and ways to manage the tax impact. Request your copy today by calling 800-393-4001. That's 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, the grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
The Financial Exchange is live on SiriusXM's Business Radio Channel 132, weekdays from 11 to noon. Get the latest business and financial news from across the country and around the world, and keep up to date on how it might affect your wallet. That's the Financial Exchange, weekdays from 11 to noon on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
This year's DAV 5K is sold out, but you can still help our great American heroes. The race is Saturday, November 8th at Castle Island, and you can visit dav5k.boston to make a donation of any amount to support our troops. Your gifts help fund free rides to medical appointments for veterans and the nation's first DAV-led housing initiative, providing homes for single veterans and veteran families. Go to dav5k.boston and make your donation today.
As promised, we're now joined by Ted Rossman from Bankrate, here to talk about their 2025 holiday spending survey. Ted, how are you today?
Doing well. Good to be here.
What are some of the big takeaways from this survey?
People are a bit reluctant to spend this year, whether we're talking travel or gifts. On the gift side of things, about a third say they're planning to spend less this year. About 40% are concerned about higher prices. Now, to be fair, there's also about another third that says they're going to spend more, and everybody else is about the same. So kind of a mixed bag there. On the travel front, 21% say they're going to travel this year for the holidays. Last year it was 27%. I take all this with a bit of a grain of salt because, as we know, the consumer mood has been very depressed this year. A lot of actual spending has come in better, but people are a little skittish as the holiday shopping season gets underway.
When you talk about that skittishness, is that concentrated in any one particular area, any one particular demographic, or anything like that?
Upper income households are faring the best. Moody's says that the top 10% of earners are accounting for 50% of all spending, which is an all-time high in a data set that goes back to the late 80s. So upper income people are more insulated from this, but they're actually the ones who are propping up a lot of the overall statistics. We do see a lot of cutbacks among lower and middle income households. That's one of the reasons why the overall numbers look better than what a lot of people are reporting. In our holiday travel survey, we found that people in their 20s and 30s are the most likely to be cutting back. That often correlates with parents of young kids. Many people are feeling that cumulative weight of inflation. It's not that prices have changed a lot over the past few months or even over the past year, but it's when you go back to, let's say, the start of 2021, prices are up 25%. As a result, people have dipped into savings, they've taken on debt. We're seeing some weakening in the job market. All this is adding up to a cumulative weight that people are just not feeling as spendy this year.
So this is the point where I ask the tough question, which is, even though everyone's saying they're not going to spend as much, we haven't seen any real shift in spending trends over the course of this year in the aggregate. This spending data, whether you're looking at retail sales, credit cards, like however you slice it, has continued to be pretty good. Why should I listen to what people are telling me when their behavior for the last 9 months says something different?
Well, that's a great point. The TSA screened a record number of passengers per day in the first 9 months of the year. Last year was a record. The year before that was a record. It looks like this year could be another record. So yeah, it's kind of like what gives. People are saying one thing, they're doing another. Consumer sentiment has not been as predictive the past few years. Really, ever since the 1970s, everybody always thought consumer sentiment was this great predictor. It was this leading indicator. It was for a long time. It really hasn't been ever since the pandemic set in. The past 5 years, consumer sentiment has been really depressed, and a lot of the actual numbers have been better. Now, first it was COVID stuff. Now, lately it's been inflation, it's been tariffs. People are climbing the wall of worry, though. They say that with stocks sometimes. It's happening with consumer spending right now, is that people are complaining about the cost of living, and they're spending anyway. Sometimes because they have to, because these are necessities, but sometimes because they want to. Travel, dining, concerts, sporting events, all these have been hot areas. Inflation is weighing on sentiment, but the bark has been worse than the bite when it comes to actual data.
When we talk about consumers taking on debt for their holiday spending, how is that debt typically showing up? Is it credit cards? Is it buy now, pay later? Where is it happening?
Primarily credit cards, but buy now, pay later is a growing segment of this. Buy now, pay later tends to grow 10, 12, something like that % every year in recent years, especially around the holidays. Credit card balances are much higher. I mean, the buy now, pay later market only accounts for something like 3% of the credit card market. So we really do look primarily at the credit card when we're talking about debt. The average interest rate is about 20%. Many store cards are north of 30%, so that's a buyer beware if you're at the checkout counter this holiday season and they offer you the store's branded credit card. Half of credit card holders carry debt from month to month. In our surveys, about a quarter of holiday shoppers say they're taking on debt for retail. About a third say they're taking on debt for travel. Frankly, I fear the toll will be higher just because half of credit card holders already have debt from month to month. So directly or indirectly, they may be adding to that. Not to say you can't have any fun, but try to set a good budget ahead of time. You still have 5 paychecks between now and the end of the year. Set money aside from each of them. Consider a 0% balance transfer card to pause that interest clock for up to 24 months. And maybe even consider cutting back. Maybe you talk to your family about, hey, could we buy fewer gifts this year? Others' heads may get nodding.
Ted, appreciate you joining us today. Thanks so much for the information.
Anytime. Thank you.
It's Ted Rossman from Bankrate talking about their 2025 holiday spending survey.
All right, time for trivia here on the Financial Exchange. And today is Paul Simon's 84th birthday. In 1986, Simon released his most successful and acclaimed album, Graceland. The hit single from that album was You Can Call Me Al. So our trivia question today, which famous comedian starred alongside Simon in the music video for You Can Call Me Al? Once again, which famous comedian starred alongside Paul Simon in the music video for You Can Call Me Al? Be the 5th person today to text us at 617-362-1385 with the correct answer, and you win a Financial Exchange Show t-shirt. Once again, the 5th correct response to text us to the number 617-362-1385 will win that Financial Exchange Show t-shirt. See complete contest rules at financialexchangeshow.com.
Taking a look at markets as we move towards the bottom of the hour. The Dow is now up 582 points. The S&P is up 96, and the NASDAQ Composite up 435. So markets continuing to stretch their legs further as we continue today. Again, now having recouped about half of what they lost on Friday. We'll see if we continue to see a little bit of momentum in that direction as we continue here. Let's take a quick break. When we return, we've got the trivia answer. We got Wall Street Watch, and then let's talk home building after this.
bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. If you're approaching your 70s, you might be thinking about slowing it down, but the IRS is just getting started. Required minimum distributions, or RMDs, kick in starting at age 73. And if you were born in 1960 or later, that number jumps to 75. RMDs are more than just a box to check. They can impact your taxes, your income plan, and even what you leave to your heirs. If not done properly, it could mean big penalties, but getting them right might help keep your money working for you. Our latest guide, Understanding RMDs, breaks down how they work, when to take them, and strategies that may make them less of a tax headache and more of a financial opportunity. Request your copy today by calling 800-393-4001 or by visiting armstrongadvisory.com. That number again is 800-393-4001 or armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping and the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served nearly 20 years, and we are so proud to have him and his business as a key partner and a presenting sponsor of the DAV 5K Boston. The DAV Department of Massachusetts does incredible work, and it's one of the first organizations that Mark became familiar with after his military service ended back in 1984. As Mark built his company, he knew he'd be giving back to fellow veterans who needed jobs, support services, medical supplies, and so much more. Mark works with disabled veterans every day, and it's one of the key reasons why he's such a big supporter of Dan Stack, the DAV Department of Massachusetts, and the DAV 5K Boston. You can join Mark Vonner and his team and make a donation to the DAV Department of Massachusetts or become a sponsor of the DAV 5K Boston. Simply visit dav5k.boston. That's dav5k.boston.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about the implications of gifting assets away. Todd, since the estate tax laws are projected to change on January 1st of 2026, significantly reducing the estate tax exemption, does it make sense to gift away assets right now?
You know, it's a big question mark. You have to think of a few things. One, look at the size of your estate. If the exemption falls to $7 million each and you're married, you can still die with $14 million of assets and not have an estate tax. So gifting might not be important from a federal gift tax situation. But the state exemption is only $2 million, so you can only shelter $4 million. So you might want to gift to reduce your state estate tax. However, there's basis to consider. If you give away low basis assets, you're trapping capital gain. And to do that, you might be paying more in capital gains taxes later when the kids sell the assets than you're saving in just Massachusetts estate tax. So you really got to think about whether it makes sense to gift or not. And if you're going to gift, you should probably set up a gifting trust. People might be gifting large assets away and not gift the assets directly to a child. Have them in a trust for the child's benefit and then protect those assets for them.
Educate yourself about the implications of gifting your assets away. Request your free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699. That's 866 848-5699, or you can request a copy from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
The markets are rebounding from Friday's sell-off after President Trump posted to social media yesterday in a follow-up to his Friday post saying, "Don't worry about China, it'll all be fine." Trump's initial post on Friday was critical of China, threatening massive tariffs. Right now, the Dow's up 1.3% or 628 points higher. S&P 500 up 1.5% or 100 points higher. NASDAQ up nearly 2% now or 438 points. Russell 2000 is up 2.2%. Bond market closed today in observance of the holiday, and crude oil is up 1.33%, trading at $59.70 a barrel. MP Materials surging 23% now after the Pentagon recently took a stake in the rare earths producer, adding to its recent rally. Last week, China tightened rare earth export controls. Other miners are seeing gains on the day, including USA Rare Earth, Critical Metals, and Energy Fuels. Meanwhile, shares in Broadcom rallying over 9% following news that OpenAI signed a multi-year pact with Broadcom to collaborate on custom chips and networking equipment, where the two companies will jointly build and deploy 10 gigawatts of custom AI accelerators. Elsewhere, shares in Warner Brothers Discovery rising 4% following reports that the company had rejected Paramount Skydance's proposed buyout of roughly $20 a share. Furthermore, reports also say that Paramount CEO David Ellison is making a play to buy all of Warner before it splits and may take his offer directly to shareholders. JP Morgan Chase up over 2% after the bank said it would directly invest $10 billion in companies it deems critical to national security. Speaking of which, JP Morgan Chase and other major banks, including Wells Fargo, Goldman Sachs, BlackRock, and Citigroup, will post their third quarter earnings tomorrow ahead of the open. Outside of banks, we have Johnson & Johnson, Ericsson, Domino's, and Albertsons all reporting their earnings ahead of tomorrow's opening bell. I'm Tucker Silva, and that is Wall Street Watch. And in the prior segment, we asked you the trivia question: which famous comedian starred alongside Paul Simon in the music video You Can Call Me Al? That would be Chevy Chase. Scott from Chelmsford, Mass. is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Scott. We play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Mike, we got a piece here from Bloomberg Opinion. Squeezing builders isn't the way to lower housing costs. What are we talking about on this?
Mainly we're talking about a tweet from Bill Pulte, who's the Federal Housing Finance Agency Director. Quote, "When I was young and growing up in Pulte Homes business, big home builders had less than 10% of the market. Today, that number is 50% and some say 60%. With great market share comes great responsibility. I encourage all builders to realize this, and sooner rather than later." So I think it's mainly a backlash to that one tweet, basically saying, look, adding threats to, monopolistic businesses in the housing sector is not a great way to build new homes, to which I have to say I agree, because according to the National Association of Home Builders, whose data goes back to 2022, and really any time over the last couple decades, the highest percentage of homes that was represented by the top 10 home builders was 43.2% according to them back in 2022. Maybe there's new data out that indicates 50%, but if the top 10 is making up 50 to 60% of the new home building,
it's pretty fragmented.
That's not a monopolistic business, and no judge is going to find it as such. So I don't think that adding pressure to the home builders and threatening them with, because that's what this is, right? When you have a government official saying, hey, figure this out because you represent a huge portion of the new home building. What they're talking about is a threat to their monopoly status, and that's not seemingly, to me at least, what is going on in this industry.
No, I mean, you take a look just as an example, and just some of the big home builders that are out there, and as an example, Lennar Corporation, they right now their trailing 12-month margins are 9.7%. In May of 22, they were 21%. If you look at the long-term average, it's generally around 5 to 7% is kind of where their margins have been. So they're a little high, but you sit there and you say, okay, if their margins compress by 2%, that makes the average home $8,000 cheaper. Is that really the thing that moves the needle? I don't think so.
And by the way, that company back in 2022 had apparently 10.7% market share, according to the National Association of Home Builders.
Okay. If you look at KB Home, their margins peaked right around the same time, about 15%. They're also down to about 9% right now. So I think that when we look at this, a couple things that I try to keep in mind on this. The first is it's a fragmented market, especially once you get out of like the Southeast and Southwest.
It's incredibly competitive.
Like you don't have these giant developments that happen in the Northeast or the Pacific Northwest. A big development in the Northeast is like 80 units, whereas a big one in Florida is like 20,000 units.
Yeah.
So
the question to ask yourself is, are big home builders preventing access to homes and intentionally raising prices? Or raising prices illegally? And the answer is very clearly not.
Well,
not with those margins.
If home builders want to make more money, I mean, you think about it just very simply. To make more money, you want to sell more units at a higher price. Mm-hmm. If home builders thought they could make more money, they can do it one of two ways. They can raise prices or make it up on volume.
Yep.
If there's one thing we know about how the world works, you rarely make it up on volume. And so I think ultimately the problem with home building, it comes back to, mostly a lot of local land use laws and things like that where, hey, if people actually wanted more homes and more affordable homes in their towns, they would vote in that fashion.
Yeah.
But we don't vote that way.
Yeah, the problem to housing affordability isn't monopolies, too big of home builders. It's not home builders sitting on vacant lots that they don't want to develop. It's not tariffs, by and large. The problem with high home prices is that nobody wants more homes. Very simple.
The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise, port upgrades, better air connections, and a sharper focus on cultural experiences have put the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping. In the world-famous Magens Bay, St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visit usvi.com.
So every now and then, Tucker, hits like a stroke of stack genius here, and he did it again.
It really
today.
is an art.
It is like I've never watched Tucker put together the stack, but I kind of picture him, just kind of swaying in front of a couple monitors and just occasionally like, ooh, that looks good.
It's like that Tom Cruise movie where he has to direct all the stuff.
Minority Report.
Yeah, that one.
Except without the whole idea of pre-crime and everything being a thing.
Yeah. Yeah,
because
just
you can't
that one
arrest someone before criming.
Right.
They have to crime first. In this case, Tucker knocked this one out of the park. Here are the headlines. From Bloomberg, this market is nothing like the dot-com bubble. From Market Watch, this is the dumbest stock market in history.
Those seem to contradict each other, don't they? We should get these two in a room.
We really should. So, when it comes to, dot-com bubble versus dumbest stock market in history, it's true. This is nothing like the dot-com bubble.
Sure. Very different.
It might be the dumbest stock market in history, which means both of these headlines can actually be true.
So, to summarize the first argument that this market is nothing like the dot-com bubble, the biggest compelling piece of evidence that Nir Kesar presents, at least in my view, would be that the earnings growth has been really strong. It's predicted to continue to be strong, and that is really all that investors care about. Is ultimately, if earnings growth is strong, then stocks can continue to go up. My counterpoint would be, I don't think investors in 1999 expected earnings growth to start falling. But once it did, stocks fell dramatically. Yes. And it eventually did start falling. And so I don't know why this would make this moment different than that one.
Correct.
Someday earnings might fall again, in which case I bet stocks would too.
Right. Look, if you actually believe that we're going to become the United States of NVIDIA, okay,
Sure.
like that's reasonable. People can disagree. But if you actually believe, hey, NVIDIA is a $4 trillion company today and it should be $40 trillion in the next 5 years, there's not much I can say to dissuade you. And by the way, like, you might be right. Like, I don't know. Like, you could be. On the other hand, like, history tends to suggest that
Sure.
won't be the case. The case for this being the dumbest stock market in history is, I mean, look, in my personal opinion, you're competing against two other markets. Maybe three for dumbest.
Okay.
2021.
Yeah.
Where we had Trevor Milton pushing a truck down a hill saying it was electrically powered and it wasn't.
We had SPAC mania, we had meme stock mania, we had all sorts of non-fundamental based driven
We
stock
had
returns.
Long Island Blockchain Company. I mean,
Yep.
like we had like
that one feels dumber.
We had some real. Well, here's the thing.
Stack the evidence for me. You're good. You keep going.
You've got all these companies in the last like month or two that have started saying they're going to be cryptocurrency treasuries, that they don't really actually do anything.
Yep.
You've got this whole circular thing going on in AI right now where everyone's just trading the same dollars back and forth and no one might actually make any money off those things. Other things that you have going on right now, you got an awful lot of spackiness out there today as well. So like, I mean, Chamath launched a new SPAC.
Sure.
That's all you need to know.
What was the other one other than 2021 in your mind? 99?
1929.
29. Okay.
Because I don't actually think 99 was... Here's the thing about 99. It was
Pets.com?
Betting on Pets.com as part of like a diversified portfolio was not a problem.
Yeah.
You could actually make a case that 2001... And I'm not just saying like the popping of the tech bubble, like once you started getting into like the Enron and WorldCom frauds, that's where the real problem was. Like startups being overvalued by people that got, all hyped up on them. Tale is old in time.
Sure.
So
So 1929, 2021, and right now.
Yes. Other than that, like it's kind of hard to find like a time when things have been dumber. Because the other thing that you have going on now...
Can you give me some 1929 context?
Let me give you more now, just while we're talking about it. You have companies that are like going public now. This whole like stable coin thing.
Sure.
You're basically a bank. Why are you going to be like so much more transformative than a bank?
I would say even less so.
And when the banks
you're basically a gift card.
And when the banks start doing this, why are you going to still exist?
Yeah.
So like there's some dumb there.
Sure.
You had some of this stuff back in 29 as well. Like this is time is a flat circle.
Okay.
Yeah, there's that. Let's take a quick break. When we come back, let's do a little bit of stack roulette. I can expand on 29 as well.
Sure.
Hear the Financial Exchange every day from 11 to noon on SiriusXM's Business Radio Channel 132. Keep it here for the latest business and financial news and the trends on Wall Street. The Financial Exchange is now live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Turning 70 isn't just another birthday. It's when the clock starts ticking on your retirement withdrawals. At age 73 or at age 75 if you were born in 1960 or later, you need to start withdrawing money from your IRA. They're called required minimum distributions, and missing one can mean big penalties. Taking the RMDs at the wrong time can also spike your tax bill. Even the type of account matters, since your IRA and 401k follow different rules, which could get confusing fast. Our new guide is called Understanding Required Minimum Distributions. distributions. It breaks the process down in simple terms so you know when to start, how much to take, and ways to manage the tax impact. Request your copy today by calling 800-393-4001. That's 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Cushing & Dolan want to help you make the most of your estate plan, starting with how you gift your assets. Their brand new guide, Making the Most of Gifting Assets, breaks down the pros and cons so you can avoid costly mistakes. Gifting may sound simple, but it can create complications you may not see coming. For example, if you gift your primary home to your kids and they sell it, they could face huge capital gains taxes, and that surprise bill could derail your plan. It's the kind of insight that can help you protect what you've built and keep your family's future on track. Whether you're just getting started or you're deep into your estate plan, this guide from Cushing & Dolan is a must-have to make smart, informed decisions. Call 866-848-5699 right now to get your copy. That's 866-848-5699. Or request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Mark Vonner is the CEO of Veterans Development Corporation. His dedication to serving our veterans has made an incredible impact on his family and employees. And he is so proud to be the presenting sponsor of the DAV 5K Boston.
This is Brittany Vonner. I'm a registered nurse who is now working as an assistant project manager at Veterans Development Corporation. Working with my father, Mark, has been an incredibly rewarding experience. Our company is dedicated to serving VA hospitals and veteran communities. We don't just build facilities, we build environments that support healing, resilience, and family. We are so proud to see our work directly impact the lives of veterans and the professionals who care for them. This rich history is why we care so much about supporting great organizations such as the Disabled American Veterans Department of Massachusetts in the work they do to care for our veterans.
Join Veterans Development Corporation in thanking our great American heroes. Please visit DAV5K.Boston to show your support today.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
The Financial Exchange streams live on YouTube. Like our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
Mike, what do you got for me for Stock Roulette?
I would like to present the Wall Street Journal's 5 ideas for helping solve America's student loan program.
Problem.
Which include... What did I say?
Program.
Oh, sorry. Problem. Offering more aid, colleges specifically, automating loan repayment, workplaces pitching in, presumably for repayment, longer grace periods for those student loans, and then states, quote, stepping up. Can anyone answer me why you write a 5-point plan on bringing down the cost of education without talking about bringing down the cost of education?
Because it's not actually a plan to bring down the cost of education.
I mean, I know it's not. I know it's slightly different between bringing down the cost of education and fixing the student loan program, but they seem pretty interrelated. You seriously didn't propose anything on reforming how universities work. and how they finance themselves and how they deliver education to their students to make it maybe slightly more cost efficient for some types of areas.
Well, here's the other thing, and look, this is not to slight Notre Dame, who is providing this new grant package for families. Most colleges aren't Notre Dame.
Sure.
Like, I don't know exactly where it stands, but I'm guessing Notre Dame is somewhere in the top 25 endowments nationwide.
Seems likely.
Like we're talking billions of dollars,
Sure.
not millions of dollars. And so most schools
can't do it.
Can't do that. Like if you are any other, and look, I'm a big believer. You go to just about any school and commit yourself, you're going to get a darn good education. You go to any school and just fool around, you're going to get a crappy education,
Sure.
regardless of how good the school is. You may be able to cover it up at a good school because of the networking connections that you can get there.
Yep.
But ultimately, if you apply yourself anywhere, whether it is Notre Dame, North Dakota, Appalachian State, Duke, wherever it might be, you can get a good education. So this, like Notre Dame being like, hey, we can do this. Okay, Appalachian State can't.
Right.
So that's not really like
Fixing
a
any of the
solution for
problems.
them. Automating loan repayment. So saying, okay, your loans are going to be automatically withheld just like taxes. Well, that doesn't really fix the student loan system.
It might make it worse.
Like, what does that do?
Yeah.
Like, there aren't many people out there that are like, hey, you know what I'm going to do? I'm going to screw over the student loan system. No, most people are like, I took out these loans and they're like, it's really hard for me to pay them back and I'm going to do what I can. And they're following me forever, and now the interest just keeps adding up, and what do? Oh, great, like, my life is finally over now, and after 60 years, I still owe these.
I was just floored by this, that, like, no single proposal had anything to do with looking at the efficiency of delivering education to students.
No.
Right? You could put in...
Workplaces pitch in. Okay, you think they're not going to cut salary as part of that then? Because there's only so big of a compensation bucket.
Yeah.
States step up. Oh, yeah, all these states with money just sloshing around in their coffers. They have plenty of money to put towards covering student loans. Like, these, I'm sorry, they're not answers.
Garbage proposals.
They're not answers here, in my opinion. So, I don't know. They're just that.
Not saying you shouldn't do any of these things. I'm just saying it's not fixing the root cause of the problem, which is that delivering education in the United States is extraordinarily expensive.
Baby boomers still love their department stores. Here's what they know that Gen Zers don't. That department stores still exist.
So you're not optimistic?
Not really. Like, the whole thing is like, hey, like, if you order from, like, the Bloomingdale's in New York City, they'll make a house call to an apartment in New York City to deliver your thing. Yeah, I'm sure that's really affordable for Bloomingdale's to do everywhere, and most people can totally afford to shop at Bloomingdale's in New York City. Quick break here for the rest of the day. We'll see you tomorrow on the Financial Exchange.